Imagine waking up one morning, opening your bank account, and realizing that a system you barely understand has been studying how you move your money. Not just the large transfers, not just the unusual wires, not just the stock sales, business deposits, or cash withdrawals that you might expect a bank to notice. Every deposit, every withdrawal, every movement between accounts, every time money comes in and every time money goes out. Now imagine that you are retired. You are not trying to hide anything. You are not running a business in the shadows. You are not avoiding taxes. You are not laundering money. You are simply managing the savings you built over a lifetime, paying bills, helping family, drawing from retirement accounts, and moving money the same way you have always moved it. And then one day, without meaning to, you cross a line. That line is $10,000. What worries me is not that the line exists. Every financial system needs rules. What worries me is that most people do not understand how old that line is, how much the world has changed around it, and how easily an ordinary person can look suspicious inside a system that is built to detect patterns, not intentions. Starting around the 2026 environment, that $10,000 number means something different than it meant in the past. Not because the number suddenly became larger, it did not. That is part of the problem. It means something different because the systems around it became more automated, more connected, more aggressive, and more capable of comparing your bank activity to your tax life. That is why I want you to listen carefully. This is not about fear. This is about understanding the machine in my life. I learned that if you do not understand how a system works, you will eventually be surprised by it. And when the system involves your savings, your retirement income, your bank account, and the government's ability to ask questions about your money, being surprised is not a small problem. It can become a serious problem very quickly. Let me make this real with a simple story. Patricia is 71 years old. She is a retired school teacher in Ohio. She is not wealthy, but she is stable. She worked for decades. She saved what she could. She receives Social Security each month. She has some retirement savings. She has a checking account and a savings account. She is the kind of person who has spent her life doing things carefully. Every month, her Social Security check arrives by direct deposit. Every few months, she moves money from savings to checking for a larger expense. Sometimes it is a medical bill, sometimes it is a home repair, sometimes it is travel to see her grandchildren, sometimes it is money she wants to give to a child or grandchild because she would rather help while she is alive than have everything pass through an estate later. None of this is criminal, none of this is unusual, none of this is immoral, but to an automated system, Patricia is not a retired teacher with a history, a family, and a lifetime of honest work. She is a data pattern. The system sees deposits, it sees withdrawals, it sees transfers, it sees timing, it sees size, it sees whether the pattern is normal for her account. And when the pattern crosses certain thresholds, or looks like it is being managed to avoid thresholds, the system does not pause and say, this woman taught third grade for 35 years. It does not ask whether she is helping a grandchild. It does not know whether the roof is leaking. It only sees a pattern that may require attention. That is the new reality that millions of seniors are moving into without understanding it. And when people do not understand the rules, they can accidentally create the exact patterns the rules were designed to catch. To understand why this matters, we have to go back to the beginning. The $10,000 bank reporting rule goes back to the Bank Secrecy Act of 1970. The purpose of that law was understandable. The government wanted to detect money laundering, drug trafficking, tax evasion, and other forms of financial crime. Those are real problems. A society cannot function well if money can move through banks in large amounts with no accountability at all. Under that law, banks were required to file a currency transaction report when a customer deposited or withdrew more than $10,000 in cash. The important word there is cash. The other important thing is the number $10,000 in 1970 was a very different amount of money than $10,000 today. In 1970, $10,000 could represent more than many Americans earned in a year. It was a large amount of purchasing power. It was the kind of cash movement that reasonably could suggest something unusual, but the number did not move with inflation. That is the part most people miss. Prices changed, wages changed, medical bills changed, home values changed, car prices changed, retirement account balances changed, the cost of replacing a roof changed, the cost of helping a child with a down payment changed, but the threshold remained $10,000. When a rule stays fixed while the economy around it grows, the rule changes in practical effect even if the words on the page do not change. That is how systems work. A fixed number inside a changing world becomes a larger net over time. What once caught unusual financial activity can begin catching ordinary financial activity. And that is what has happened. A threshold designed for another era now intersects with the normal financial life of retirees all the time. A retiree takes a required minimum distribution. A retiree sells a car. A retiree receives inheritance money. A retiree pays a contractor. A retiree helps a grandchild with college. A retiree transfers savings to pay for assisted living. These are not exotic events. They are part of aging, family, retirement, and normal life. Yet many of them can cross the old $10,000 line. And once the line is crossed, the transaction may enter a reporting system that most people never see and do not understand. The first thing to understand is the currency transaction report. That is the basic report banks file when cash transactions exceed the threshold. Most of the time, people never hear about it. The report is filed quietly. It does not automatically mean that you did anything wrong. It does not automatically mean that the IRS is going to audit you. It is a data point, but data points matter when they accumulate inside a system. There's another report that matters even more. That is the suspicious activity report. A bank can file one when it believes account activity may indicate illegal activity or an attempt to avoid reporting requirements. The bank does not have to prove a crime occurred. The bank only needs a basis for suspicion under its compliance standards. This is where ordinary people get into trouble. Because suspicion in a compliance system is not the same thing as suspicion in human judgment. A person may say, "I know why I made those deposits." A bank system may say, "The pattern resembles structuring." That word is extremely important. Structuring means breaking a larger transaction into smaller transactions for the purpose of avoiding the $10,000 reporting requirement. For example, if someone has $30,000 in cash and deposits $9,000 one day, $9,000 the next day, and $9,000 after that, a bank may conclude that the person is trying to stay under the reporting threshold. That can be a federal crime. The mistake many people make is thinking that the money itself has to be illegal. It does not. The money can be legitimate. It can come from savings, it can come from a home sale, it can come from an inheritance, it can come from a business, it can come from anything lawful. The issue is whether the person intentionally shaped the transactions to avoid the report. That is why I say that intent matters legally, but patterns matter operationally. The government may have to prove intent in a criminal case, but the bank's software does not wait for a courtroom. It flags patterns first. Human review comes later. And by the time a human review happens, a report may already have been filed or an account may already be under scrutiny. This is especially dangerous for seniors. Many older Americans learned money habits in a different era. They may prefer cash, they may distrust banks, they may move money in smaller pieces because that feels safer. They may avoid large deposits because they do not want attention. They may have watched parents live through financial instability and learn to keep control of money physically. Those habits may feel prudent inside the modern reporting system. They can look suspicious. That is the gap that causes trouble. There have been real cases documented by civil liberties groups where the government seized bank accounts because deposit patterns looked like structuring. Even when the people involved were not charged with crimes, the money was legitimate, but the pattern created a problem. In some cases, people spent months or years fighting to get their own money back. When you are retired and living on a fixed income, losing access to $20,000 or $30,000 is not a paperwork inconvenience. It can change your life. It can affect medical care, housing, taxes, family support, and your ability to sleep at night. That is why this is not a theoretical issue. Now let us move into what is changing as we approach the 2026 environment. The important thing is not simply one new rule in isolation. It is the combination of old thresholds, newer enforcement priorities, expanded data analysis, and better technology. When those things combine, the system becomes more sensitive. The IRS has received large amounts of funding in recent years, and part of the purpose of that funding has been to modernize technology, improve data analysis, and increase the ability to cross-reference information. In practical terms, that means the government can compare reported bank activity with reported income more efficiently than it could in the past. It can look for inconsistencies, it can look for cash flow that does not match a tax return, it can look for patterns that suggest unreported income, unexplained transfers, or attempts to avoid reporting. Again, most reports do not become audits, but the system is becoming better at finding anomalies. And for a retiree, the problem is that perfectly ordinary retirement activity can look like an anomaly if it is not documented and explained. Social Security deposits are usually straightforward, pension deposits are usually straightforward, but many seniors also take retirement account distributions, required minimum distributions, annuity payments, or lump sum withdrawals. Depending on the size of the retirement account, these amounts can exceed $10,000 without being unusual at all. If everything is properly reported on the tax return, there may be no issue. But if the return is incomplete, if the documents are missing, if the distribution is misunderstood, or if a senior moves the money again in a confusing way, the transaction can become a source of scrutiny. This is one of the principles I have learned about systems. Small errors can become large problems when they pass through automated processes. A confused form, a missing document, a deposit that is not clearly matched to reported income, a transfer that looks unrelated, each one may be explainable. But if the system sees them before you explain them, you can find yourself reacting to a problem instead of preventing it. The next area is family gifting. Seniors often want to help their children and grandchildren. That is natural. It is one of the reasons people save. They want to see their money do good while they are still alive. A grandchild needs tuition help. An adult child needs support with a home down payment. A family member faces a medical expense. A parent wants to pass along some savings gradually rather than waiting for probate or estate administration. These actions can be legal and generous, but when money moves in large amounts, the movement should be documented. The IRS has rules around gifts, annual exclusions, and reporting requirements. Many people hear the word gift and think that because it is not income to the recipient in the ordinary sense, no documentation matters. That is a dangerous simplification. A system that sees transfers does not know they were gifts unless the records make that clear. And if multiple transfers are made in irregular amounts, or if cash is involved, or if the payments appear linked to some other financial activity, the pattern can create confusion. Confusion is not your friend in a reporting system. The next area is home sales and inheritance. This is one of the biggest financial events in retirement. A senior sells a home to downsize, a spouse dies and assets move, an inheritance arrives, a family property is sold, a retirement plan distribution is received. These transactions can involve hundreds of thousands of dollars. They are often completely lawful and properly handled, but they create large movements of money. Those movements may pass through banks, title companies, brokerage firms, and tax reporting systems. If the paperwork is clean, the system can be managed. If the paperwork is scattered, unclear, or missing, the same movement can become difficult to explain. I think of this as a cause and effect chain. The cause is a normal life event. The effect is a large financial transaction. The risk is not the event itself. The risk is that the reporting trail does not clearly show why the money moved, where it came from, and where it went. The next area is ordinary senior financial life that does not feel ordinary to software. A senior sells furniture, jewelry, a car, or collectibles. A senior rents out a property and receives rent. A senior helps a family member temporarily by holding funds. A senior receives repayments from a child. A senior combines cash from several sources and deposits it over time. In a human story, these things may be simple. In a bank system, they can look like unexplained inflows and outflows. The system sees amounts, dates, counterparties, and patterns. It does not see Thanksgiving dinner conversations. It does not see family arrangements. It does not see trust, emotion, or context. That is why context must be created through records. Now let me explain what can happen when a transaction is reported. A currency transaction report or suspicious activity report generally goes to the Financial Crimes Enforcement Network, which is part of the Treasury Department. That information can be used by law enforcement agencies, including the IRS. From there, analytical tools can decide whether a person, account, or pattern deserves a closer look. A closer look can mean a letter asking for explanation. It can mean a tax audit. In more serious cases, it can mean involvement from criminal investigators. And in structuring related situations, it can involve civil asset forfeiture. Civil asset forfeiture is one of the most controversial parts of this system because the government can take property or money based on a claim that it is connected to unlawful activity even before a criminal conviction. The burden and cost of fighting to recover the money can fall heavily on the account holder. For a wealthy person with lawyers and liquidity, that is a serious inconvenience. For a retiree, it can be devastating. This is why I want to be balanced and precise. Most people who trigger a bank report will never hear anything from the IRS. The number of reports is huge. The government cannot and does not pursue every one of them. A report by itself does not mean you are guilty. It does not mean you are being audited. It does not mean your money will be seized. But risk does not have to be certain to matter. When the consequence is severe, even a low probability risk deserves respect. That is one of the basic principles of risk management. You do not prepare only for what is likely, you prepare for what would be very painful if it happened, especially when the preparation is simple and legal. So what should a retiree do? The first and most important thing is to keep records, not complicated records. Clear records if you sell a house, keep the closing documents if you receive an inheritance, keep the estate documents and bank records showing the transfer. If you take money from an IRA, keep the statement showing the distribution. If you make a large gift to a family member, write down the date, the amount, the recipient, and the purpose. If you sell a car or valuable personal property, keep the bill of sale. If you receive money from a family member, write down why it was sent. A notebook is better than nothing. A spreadsheet is better. A folder with statements, receipts, agreements, and explanations is better still. The point is not to create bureaucracy for its own sake. The point is to make your financial life explainable. A transaction that can be explained is very different from a transaction that cannot be explained. The IRS cannot be made to ignore a report simply because you are a good person. But a clear explanation supported by documents can reduce confusion, shorten disputes, and help prevent a pattern from being misinterpreted. The next protection is to work with a professional who understands retirement income and tax reporting. Not every tax preparer understands the specific issues seniors face. Retirement distributions, required minimum distributions, large gifts, inheritance, home sales, Medicare, related financial planning, family support. These are not the same as filing a simple wage return. A good CPA, enrolled agent, or tax attorney can help you create a clean, explainable record before there is a problem. That is important because prevention is cheaper than correction. It is much easier to structure a transaction properly in advance than to explain a confusing pattern after a letter arrives. The next principle is to avoid any appearance of structuring. This is where people make well-intentioned mistakes. They say, I need to deposit $20,000, but I do not want any trouble, so I will deposit $9,000 today, $9,000 next week, and the rest later. That feels safer to them. It is usually more dangerous. If you have a legitimate reason to deposit a large amount, deposit the legitimate amount, keep the documentation, and let the required report be filed. A single clear transaction is generally less concerning than multiple transactions that appear designed to avoid a threshold. Do not make your money movement look more suspicious by trying to make it look less noticeable. That is the paradox. Many people get into trouble not because they were hiding illegal money, but because they tried to avoid attention and accidentally created a suspicious pattern. The next protection is understanding your rights. If the IRS contacts you about bank transactions, do not panic, do not ignore the notice, do not call and improvise answers without documentation. Do not assume that because you are innocent, the issue will automatically disappear. Innocence is important, but systems move through paperwork and process. You have the right to representation. You have the right to respond in writing. You have the right to have a professional help. You organize the facts. Use those rights. A calm, documented response is almost always better than an emotional, rushed response. That is true in investing. It is true in business. It is true in tax matters. When the stakes are high, slow down and make the process rational. The next protection is to make sure your family understands the rules. This matters because many seniors do not move money alone. Children help parents, parents help children, grandparents help grandchildren. Family members reimburse each other. One person may deposit cash for another. One account may be used temporarily because it is convenient. From a family point of view, that may feel normal. From a reporting point of view, it can look messy if an adult child regularly deposits cash into a parent's account to help with expenses. Document it. If a parent sends money for a down payment, document the gift. If a grandchild sends money back to repay something, document it. And when the amounts are meaningful, consider using checks or wire transfers rather than cash, because those methods create clearer trails. A clear paper trail is not the enemy of privacy in this context. It is protection. The next protection is to stay informed. The rules around financial reporting, IRS enforcement, digital payments, bank compliance, and privacy are not fixed forever. They change with legislation, regulatory guidance, court decisions, enforcement priorities, and technology. This is not a one-time issue. It is part of modern financial life as technology improves. The system becomes more capable of seeing patterns that can help detect real crime. It can also cause innocent people to get caught in machine-driven suspicion if they do not manage their records carefully. The trend is toward more data, not less. That is not a political statement. It is an operational reality when data is easier to collect and analyze. Institutions tend to collect and analyze more of it. That is why the habits I am describing are not temporary habits. They are permanent habits for managing money in a high-data financial world. Now, I want to address the emotional side of this because it is real. Many seniors feel insulted when they learn how much their bank activity can be monitored. They worked for decades, they paid taxes, they followed the rules, they raised families, they saved money carefully. And now they feel as though they are being treated as suspects for moving their own savings. I understand that feeling. It is not irrational. There is always a tension between the government's need to prevent financial crime and the individual's right to financial privacy and freedom. That tension has existed for a long time, and it will not be fully resolved by pretending it does not exist. The practical question is this: how do you protect yourself inside the system as it actually exists? That is where principles matter. Do not be naïve. Do not be paranoid. Be prepared. Naïve people assume that because they have done nothing wrong, nothing bad can happen. Paranoid people assume that every rule is designed personally against them and then make emotional decisions that create more risk. Prepared people understand the rules, document their actions, avoid suspicious patterns, and get help when the situation is complex. That is the approach I believe in. There is also a special issue around cognitive decline. As people age, financial management can become more complicated. Some seniors begin to rely on children, relatives, advisors, or friends to help move money, pay bills, manage deposits, or handle transfers. That can be necessary. But if the authority is not documented, it can create problems. If you are helping an aging parent or grandparent, make sure you have proper legal authorization, such as a power of attorney or whatever. Document as appropriate in your state and situation. Keep records of every transaction you make on their behalf. Do not mix their money with your money. Do not make informal transfers that you cannot explain later. This protects the senior. It also protects the helper. Without documentation, a good deed can look like exploitation, confusion, or suspicious movement of funds. That is not a place you want to be. There is another risk seniors must understand. Scams. Criminals know that older adults may have savings. They know that urgency and fear can cause people to move money quickly. They often instruct victims to withdraw cash, send wires, buy gift cards, transfer money, or break payments into smaller amounts. Sometimes they specifically tell people to avoid talking to the bank, family members, or advisors. That is one of the biggest warning signs. If anyone asks you to move money with secrecy, urgency, pressure, or shame, stop. If someone says, do not tell your bank, stop. If someone says, your account is in danger and you must move money right now, stop. If someone says, split the payments so nobody asks questions, stop. These scams can do double harm. They can take your money, and they can leave behind transaction patterns that look suspicious to banks and regulators. So the protection is simple but powerful. Slow down. Talk to a trusted person. Get independent confirmation. Never let another person's emergency become your irreversible financial action. There is also a larger policy question here. The $10,000 threshold is old. Civil asset forfeiture is controversial. Financial privacy is a legitimate concern. Automated enforcement can make mistakes. Seniors are especially vulnerable to being misunderstood by systems that do not see human context. If you believe the rules should be updated, you can say so. You can contact representatives. You can support organizations that work on financial privacy and civil liberties. You can ask why a threshold from 1970 still applies to a world where ordinary expenses routinely exceed that amount. But while policy debates continue, you still have to operate under the rules that exist. One of the worst mistakes people make is confusing what they believe should be true with what is true. A good life principle is to deal with reality first, then work to improve reality second. Reality is that the reporting system exists. Reality is that the threshold is still important. Reality is that technology is making enforcement more data-driven. Reality is that ordinary retirees can accidentally trigger scrutiny. Reality is that good documentation and good habits reduce the risk. That is the practical truth between now and 2026 and beyond. I believe the direction is clear. More data will be collected. More systems will talk to each other. More transactions will be analyzed. More patterns will be detected automatically. Some of that will catch real abuse and crime. Some of it will create stress for innocent people. That is how broad systems work. They solve one set of problems and create another set of risks. Your job is not to control the whole system. Your job is to understand how your behavior appears inside it. That means not breaking legitimate transactions into suspicious, looking fragments. It means not using cash when a clearer method would work better. It means not relying on memory when a written record would protect you. It means not waiting until an IRS letter arrives to organize your financial life. It means not letting family arrangements stay vague when money is moving in meaningful amounts. It means building a clean trail before anyone asks for it. Think of your financial records like a bridge. You may never need to cross it, but if a question comes, if a bank review happens, if a notice arrives, if a transaction is challenged, that bridge lets you move from suspicion to explanation. Without it, you are standing on one side saying, trust me, and trust me is not a strategy inside a reporting system. The more I have studied economies, markets, governments, and human behavior, the more I believe that systems reward people who understand cause and effect. The cause is how you move money. The effect is how the system interprets it. If you move money in ways that are clear, documented, and consistent with legitimate purposes, you reduce risk. If you move money in ways that are fragmented, undocumented, inconsistent, or designed to avoid attention, you increase risk. Even if your intentions are innocent, that distinction matters. It may be the difference between peace of mind and a very painful fight. I do not want retirees to live in fear. Fear is not useful unless it leads to preparation. I want retirees to live with clarity. You worked your whole life, you earned your savings, you should be able to support your family, enjoy your retirement, pay your bills, receive your benefits, and manage your money with confidence. But confidence does not come from ignoring the rules. It comes from understanding them. The $10,000 rule is real, the reporting system is real, the enforcement tools are real, the risks for seniors are real, but your ability to protect yourself is also real. Keep records, work with the right professional, do not accidentally structure transactions, use clear transfer methods, document gifts and family support, understand your rights, keep your family informed, be alert to scams, stay current as the rules evolve. Those are not complicated ideas, they are simple principles. And simple principles applied consistently are how you protect yourself in complex systems. If there is one thing I want you to take from this, it is this. The danger is not moving money. The danger is moving money in a way that cannot be explained. A large, legitimate transaction with clean documentation is usually manageable. A series of smaller, unclear transactions that look designed to avoid a rule can become dangerous. That is why the old habit of keeping things quiet can backfire in the modern financial system. Quiet is not always safe, clear is safe, documented is safe, consistent is safe, explainable is safe, so before your next large deposit, withdrawal, gift, home sale, inheritance transfer, retirement distribution, or family reimbursement, pause. Ask where the money came from. Ask where it is going. Ask what record proves the purpose. Ask whether a professional should review it. Ask whether you are moving it in one clean step or breaking it into pieces because you are afraid of a report. If the answer is fear, stop and get guidance. Do not let fear design your transaction pattern. Let clarity design it. That is the principle. You cannot prevent every report you do not need to. A report is not the enemy. A confusing, undocumented pattern is the enemy. The system may keep expanding, the technology may keep improving, the threshold may remain frozen. The rules may continue to feel unfair, but if you understand the pattern, you can act intelligently within it. That is what responsible financial management now requires. It is not enough to save money, it is not enough to earn money, it is not enough to pay taxes honestly. You also have to be able to show the path your money traveled. That is the world we are in, and the sooner you adapt to it, the safer your retirement money will be.